Welcome to my channel. I am going to walk you through the process of valuing 3 stocks in the communication services sector and analyzing their financial ratios. Comment if you have questions. I respond to every comment. Subscribe if you want to see me value more companies. The first company we're going to look at is trivago. This company is a search engine for hotels and travel services. Expedia Group owns a majority of the company. Even though this company trades on the US stock exchange, they report their financials in euros. So I'm going to be looking at the ticker that trades on the Germany stock exchange. Their market cap is about 600 million euros. They're trading at 1.4 euros. And to get the shares outstanding, that's market cap divided by the stock price, gives you the shares outstanding, 423 million. We're going to need this number later when we calculate the value of the company. Let's look at their financials. So free cash flow, that's how you value a company. You estimate the future free cash flows, then you discount that back to today's dollars. That's what we're doing in this video. Free cash flow is cash flow from operations minus capital expenditures. So it's the money left over after running your business and paying for property, plant, and equipment. So in 2 years, they had negative free cash flow. That means they're spending more cash than they're generating. This could happen with younger companies and newer companies when they're trying to grow their business. It could also happen when you sell a lot of products on credit and you don't receive cash for it. They also have negative net income for 3 of the 4 years, so their financials don't look so good. And their revenue isn't even growing either. It goes up in 2017, but then drops in 2018 and 2019. They do have no debt in their capital structure. They're 100% equity. And their beta is 1.27. That's how volatile the stock is relative to the market. So their stock moves a little more than the market. And to calculate the cost of equity, we use the capital asset pricing model, and that comes out to 12.07%. And that's our WACC. That's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of 761 million euros. We divide that by 423 million shares, and we get a calculated stock price of 180. It's trading at 141, so it's trading at a 22% discount. So it is a buy according to the model. Let's see what Simply Wall Street says. They're saying the stock is worth 371, so they're saying it's even more undervalued than me. I could not value this company using my traditional discounted cash flow models, so I had to use my alternative model, which I built for Tesla. That looks at the growth of the free cash flows and extrapolates that out for 30 years. Let's see where the stock has been trading out the past few years. So it looks like it was at its peak when it IPO'd around 12-13 euros, but the price has come down little by little every year, and it's at a pretty low point, so it's probably a good value if you feel this company is going to be strong in the future. Let's look at the financial ratios. They have a bad PE of 35, the median in the market's 15.5, the average is 23.4. They have a good price of sales of 0.7, the median is 1.8, the average is 5.2. A really good price to book of 0.7. The median in the entire market is 2.4. The average is 5.4. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. I like to see below 15. They're at 34.7. So investors are paying $34.70 for $1 of earnings. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5, they're at 0.7, so investors are paying 70 cents for $1 revenue. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5, they're at 0.7, so investors are paying 70 cents for $1 book value. They have a really high current ratio and a really bad ROE. Current ratio is current assets over current liabilities, so they have way more than enough current assets to cover their current liabilities, so they're not operating too efficiently. ROE is net income over equity. I like to see above 20%. They're only at 2%. And the best way to look at ratios to compare them to similar companies, I've done videos on Spotify, Facebook, Alphabet, Match Group, Yelp, and Yandex. Yandex is the Google of Russia. And here's trivago, and if trivago has a number in red, they're worse than the average. If they're in green, they're better than the average. So they have worse than average price to earnings, but they have the best price to sales and best price to book of all the companies in the industry. They have the highest current ratio of 4.9. Their ROE is lower than average at only 2%, average is 30%. Most companies in this industry have 0% debt, and they're by far the smallest in terms of market cap at only $709 million US dollars. I converted it from euros to US dollars. And none of the companies in the industry pay a dividend, so they're also at 0%. To summarize, I have them trading at a 22% discount, and the ratios are pretty good actually compared to their competitors. The second company is Activision Blizzard, and this is a video game holding company. Some of its brands are Call of Duty, Guitar Hero, and many more. Let's get started with the model. They have a big market cap, $62 billion, so they're a large cap company. They're trading at $80 a share, and they have 771 million shares outstanding. They're really healthy, consistent, positive free cash flow, $1.7 to $2 billion a year, so lots of extra cash to work with. The net income also looks pretty solid. They did have a low year in 2017, but everything else looks really good. And their revenue does go up quite a bit from 2016 to 2018, but takes a dive in 2019. Let's look at their capital structure. They have $2.7 billion of debt. They pay 3.4% interest on their debt. The cost of debt is 3.1%. That's the interest rate times 1 minus the effective tax rate. Their cost of equity is 7.5%. We figure that out using the beta. That's how volatile the stock is relative to the market. And they have a low beta, 0.7, so the stock moves less than the market. Their WACC is 6.8%, which is a blend of the cost of debt and cost of equity. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $64 billion. We discount those numbers back to today using the weighted average cost of capital. And we get a value of the company at $57 billion. We divide that by 771 million shares. And we get a calculated stock price of $74. They're trading at $80, so they're trading at 8% premium. So it is a sell according to the model, but it's really close. Let's see what Simply Wall Street says. They're valuing the stock at $57, which is lower than me. Usually they're higher than me. Let's see where the stock has been trading at the past few years. So it looks like in a little over 2 years, the stock hasn't moved. It's still at $80. It did dip, but it came right back up. So it could be a good value. This is probably a type of industry that might do well during coronavirus. Let's look at the financial ratios. Bad PE, bad price to sales, and a weak price to book. PE is stock price over earnings per share. I like to see below 15. They're at 41. Price to sales is stock price over sales per share. I like to see below 2.5. They're at 9.5. Price to book is stock price over book value per share. I like to see below 3.5. They're at 4.8. They have a good current ratio and interest coverage ratio and a weak ROE. Current ratio is current assets over current liabilities. I like to see between 1.2 and 2, but 2.5 is fine. ROE is net income over equity. I like to see above 20%. They're at 12%. Interest coverage ratio is EBIT over interest expense. I like to see above 2.0, so they can easily cover their interest payments at 19.3. The best way to look at ratios to compare them to similar companies, I've done videos on Electronic Arts and Zynga, both in the same industry as Activision. And if Activision has a number in red, they're worse than the average. If they're in green, they're better than the average. So they are better than the average in PE, worse in price to sales and price to book. They have the highest current ratio. They're in the middle in ROE at 12%. The average is 18%. They're at average in debt. 17% is the average, and they're at 17%. All the companies in this space are pretty low in debt. They're by far the biggest company of the three at $62 billion market cap. They're the only company that pays a dividend at 0.5%. So to summarize, I have them trading at an 8% premium. Their ratios look pretty good, but they're such a big company, I think they could handle almost any situation. The third and last company is Shaw Communications. This is a Canadian telecommunications company that provides telephone, internet, television, and mobile services. Let's get started with the model. They have a market cap of 12.6 billion Canadian dollars. They're trading at $25 a share. Let's look at the financials. They have negative free cash flow in 2016, but positive in 2017, 18, and 19. When you have negative free cash flow and positive net income, it could be that you're investing in your business and spending money on property, plant, and equipment. It could also be that you're selling a lot of products on credit, which means you're booking revenue onto the income statement, so your net income looks really good, but you're not receiving any cash, and you'll receive that cash in the future. But you have to always look at this type of detail before you can make these types of assumptions. The net income looks pretty solid. It is a bit low in 2017, but the other years look good. And their revenue is growing every year, so it's on the incline, but it's not really growing too much, just a little each year. They have $5.3 billion of debt. They pay 5.37% interest on their debt. The cost of debt is 4.62%, and 46% of that capital structure is debt, which means 54% is equity. Cost of equity is 6%, and the way we figure that out is using the beta. That's how volatile the stock is relative to the market. They have a beta of 0.48, so the stock moves half of what the market moves. So the stock is not volatile at all. Their WACC is 5.37%, which is a blend of the cost of debt and cost of equity, and that's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also estimate a terminal value, which is all cash flows past year 4, that's $12 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of 10.8 billion Canadian dollars. We divide that by 503 million shares. We get a calculated stock price of $21.39. They're trading at 25, so they're trading at a 17% premium. It's a sell according to the model. Let's see what Simply Wall Street says. They're saying $31, so they're saying the stock is undervalued. Let's see where the stock has been trading at the past few years. So it looks like it's pretty steady for 3-4 years. Then it dropped the coronavirus. It has come up, but it's still well below its peak prices from a couple of years ago. Let's look at the financial ratios. They have a decent PE, a good price to sales, a good price to book. PE is stock price over earnings per share. I like to see below 15. They're at 17.8. Price to sales is stock price over sales per share. I like to see below 2.5. They're at 2.3. Price to book is stock price over book value per share. I like to see below 3.5. They're at 2.0. They have a low current ratio, a good interest coverage ratio, and a low ROE. Current ratio is current assets over current liabilities, so they cannot cover their current debts and payables, so they may need to take on more debt. ROE is net income over equity. I like to see above 20%. They're at 11%. Interest coverage ratio is EBIT over interest expense. I like to see above 2.0. They're at 3.9. The best way to look at ratios is to compare them to similar companies. I've done videos on Bell Canada, Rogers, AT&T, TELUS, Vonage, Verizon, and Zoom, all in the same industry as Shaw. And if Shaw has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they are better than average in price to earnings, price to sales, and price to book. They're worse than the average in current ratio. Most companies are below 1 except for Zoom at 3.3. ROE, they're a little worse than average at 11%. They're a little better than average in debt. And they are worse than average in market cap. They're not a small company at $9.5 billion. The average dividend yield in the industry is 4.22%. They're at 4.87%, so they are above average. AT&T is the highest at a whopping 7.19%. To summarize, I have them trading at a 17% premium, but their ratios do look better than the average in the industry, and they pay a good dividend. So let me know what you think of the video. Leave a comment. I answer all comments. Subscribe if you want to see me value more companies. Thanks for watching.